Most people think a repossession is a single bad afternoon. A truck shows up, a stranger hooks a chain to your bumper, and 20 minutes later, your car is gone. Painful, embarrassing, over. That's almost completely wrong. The tow truck pulling away isn't the end of anything. It's the opening scene of a financial event that can follow you for years, quietly shaping which apartments you can rent and what interest rate you pay on everything you borrow next. To understand why, you have to stop thinking of repossession as a moment and start thinking of it as a chain reaction. Because that's exactly what it is. Here's where almost everyone gets the timeline wrong. They assume the damage starts when the car disappears from the driveway. It doesn't. A lender can't legally seize a car the day you miss one payment. The contract you signed defines default, and in most cases, you have to fall seriously behind, often 60 to 90 days, before repossession becomes an option. But your lender doesn't wait that long to tell the credit bureaus. Payment history makes up 35% of a standard credit score, the single heaviest factor in the entire formula. And a 30-day late mark gets reported the moment it happens. So by the time the tow truck actually arrives, you haven't taken one hit to your score, you've already taken 3 or 4, spaced a month apart, each one compounding on the last. Then the repossession itself lands on your report as its own separate wound, its own code, not folded into the missed payments and forgotten. Voluntarily returning the keys because you know you can't keep paying doesn't soften this. Whether you call the lender and hand the car back, or a repo agent takes it from a parking lot at 2 a.m., the outcome on your credit file is functionally identical. Both get logged as an account that failed. And depending on where your score started, that single entry can knock somewhere in the range of 100 to 150 points off a good credit profile. Someone starting in the mid-700s can find themselves in the low 500s almost overnight, a drop severe enough to move them out of prime lending entirely. But here's the part that catches people off guard, the part that turns a bad month into a bad half-decade. Losing the car does not erase the debt. It just changes what the debt looks like. The lender doesn't keep the car. They sell it, usually fast, at a wholesale auction built for volume, not top dollar. And a car sold under time pressure almost never covers what you still owed. Say your loan balance sat at $17,000 and the auction brings in $12,000. That $5,000 gap doesn't vanish. It becomes what's called a deficiency balance. And lenders routinely add towing, storage, and auction fees on top, sometimes another $1,000 to $1,500. Now you owe money on a car you no longer have, and no asset to show for any of it, just a bill. Most people can't pay a lump sum like that, and lenders know it. So the account gets sold to a collections agency for pennies on the dollar, which has every incentive to chase you, because whatever they recover above what they paid is pure profit. A fresh collections entry lands on your report, separate from the repossession, separate from the missed payments. Another line item dragging your score down further. And if collections can't get you to pay voluntarily, the next step is a lawsuit. Get a judgment entered against you, and depending on the state, that creditor can garnish your wages, freeze a bank account, or place a lien on property you own, sometimes for 5 years, sometimes renewable indefinitely, reaching into your paycheck a decade after you stopped driving the car. Now, you might assume there's a reset button here. There is, technically. Federal law limits how long most negative items can stay on a credit report to 7 years. But that clock doesn't start on the day the repo truck showed up. It starts from your first missed payment, sometimes months earlier. And even once the 7-year window closes and the entry drops off your report, an underlying deficiency judgment can still be legally collectible under state law, long after your credit report has moved on. Your score can partially recover while a court-ordered debt is still actively pursuing you. The wound heals visibly, while the infection keeps spreading underneath. To see how deliberately this cycle gets engineered, look at a corner of the auto industry built almost entirely around it: buy here, pay here dealerships. These lots sell older, high mileage vehicles directly to buyers who can't qualify for a conventional loan. And because the dealer finances the car in-house, instead of selling the contract to a bank, they aren't bound by traditional underwriting rules. They can approve almost anyone at interest rates well above what a bank would charge, sometimes 20 to 30%. An industry consultant once described the real product with unusual honesty. These dealers aren't selling cars, they're selling money. A conventional dealership typically nets a profit margin of only 2 to 4%. A buy here, pay here operation can net closer to 12%, and a meaningful share of that profit comes from what happens after the buyer defaults. The dealer repossesses the same car, cleans it up, and finances it right back out to the next buyer at the same steep terms. Some operators report repossession rates above 20% of their entire portfolio in a given year. And instead of treating that as a failure, they've built it into the plan. One car, repossessed and resold 3 or 4 times, can out-earn a single buyer who simply paid it off. The person losing their car isn't a mistake in this model. They're a recurring revenue event. This isn't a fringe story at the edges of the auto market. Heading into 2026, the share of subprime auto borrowers at least 60 days behind on their car payments climbed to the highest level recorded since the early 1990s, surpassing even the peak of the last major financial downturn. Repossession volume has surged alongside it, with millions of vehicles pulled off the road in a single year, and a growing share of borrowers now owe more on their loan than the car is worth, a gap known as negative equity that leaves people trapped before they've even missed a payment. Longer loan terms, higher rates, and rising vehicle prices have stretched buyers further than they can hold. And when the string finally snaps, it doesn't just cost them a car, it resets their financial identity for years. Here's something else that surprises most people. Most states don't require a lender to get a court order before taking your car. Under what's called self-help repossession, an agent can walk onto your property, hook up your vehicle, and drive off without a judge ever being involved, as long as they don't breach the peace, meaning no physical confrontation, no broken locks, no forced entry into a closed garage. That single legal boundary is often the only thing standing between you and a vehicle disappearing from your driveway at any hour, with no advance warning beyond what your original loan contract specifies. It's often a single, quiet transaction that happens the moment the lender decides it's worth the trip. So when you step back and look at the entire arc of this, from the first missed payment to the auction sale, to the collections call, to the court judgment that can outlive the credit report itself, the honest way to describe repossession isn't as an event at all. It's a chain. And every link in that chain was built by someone with an incentive for it to hold. The lender wants the deficiency balance recovered. The collections agency wants their cut. The dealer, in some corners of this industry, wants the same car back on the lot, generating profit a second and third time. None of these parties are rooting for your credit score to recover quickly, because in every one of these systems, your continued financial strain is somebody else's revenue line. Which brings us back to that image we started with, the tow truck pulling out of the driveway. It looks like an ending because that's the last part of the story you actually get to watch happen in real time. Everything that follows, the score drop that was already underway before the truck arrived, the auction sale that turns a missed payment into a bigger debt, the collections chase, the possible judgment that can outlast the credit report entry itself. All of that continues long after you've stopped watching. The real cost of a repossession was never the 20 minutes it takes to lose the car. It's the years it takes to actually be free of it. If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.